Taking a look at the dollar yen price analysis is another unwind coming at 140. Pete, when I put this together over the most recent weekend, dollar yen was trading 141.5.
Right.
It's bounced around those levels a couple of times here in the last couple weeks. I thought that, maybe this is something looking forward. We might get 140 in the next week or two. Might get it in the next couple hours as this dollar continues to drop and this yen market continues to surge for a number of reasons, which we'll get to in a second. But dollar yen right now trending lower throughout 2025, down 10% on the year, Pete. And of course, this comes after, and we'll get to more historical prices in a second. You remember September to December last year.
Right.
And this was on the back of the last time we were talking about a carry trade unwind, summer 2024.
Right. August, right? Yeah.
Where this dollar yen market gets down to 140, and that's about as much damage as they do. And then they rally it all the way back to above 155. I think they got to 157 and change. Well, you can see here to start 2025, we're trading 158 a couple of times. Now off 10% in the first quarter plus of this calendar year. And 140 very much, 140 at this point here on April 21st could be hit within the next couple of hours. The low that we're looking at in this market going back to summer of 2023, pretty violent move. We're going to get into a couple of reasons, but I want just your gut feel, especially the last couple of weeks, let's say since the start of April, where we've dropped from around 150 down to now close to 140. What do you think is the one reason? I know this is classic like history class. What's the reason the Civil War happened? What's the reason World War I happened? It's hard to pin it on one thing. But what is...
Are you asking that because you think I fought in both those wars?
What is the reason that this dollar yen market is trending lower so violently?
I think it is not so much the yen is great, but the dollar's not so good.
Yeah.
And the idea that you baseline yen over the last 20 years is closer to 105 or 108. You could say the same thing about euro. It's 122, cable's 138. So I only say that in perspective that, yes, 115 is an awfully big run. 150 to 140 in the yen is an awfully big run. But keep that part of context in your mind. I think it's really this idea of a bigger thought on we're not going to hold treasuries, so we don't need dollars. And U.S. equities don't have a really good story behind them right now. If that's the case, the demand for dollars overall, because again, you need to have, wherever you are in the world, you need dollars to buy U.S. equities. You need dollars to buy U.S. treasuries. If those decisions are coming off the table, you don't need so many dollars. And when I say you, the collective, the global,
the market,
yeah. And I think this is, does the currency run ahead of those ideas? Absolutely.
Sure. And you're seeing the indiscriminate dollar selling, but it is particularly violent in this, and it might be some of that, like you say, that price action.
And this is where the glue of math comes undone.
Yeah, because you still have a great disparity between interest rates in the U.S. and Japan. You still have 4%.
10 years are higher than this right now, right?
So still a huge gap that needs to close if this dollar yen is going to maybe move back to those historical prices around 100, 110. We'll see. I mean, obviously anything on the table, but you're still seeing U.S. rates for the time being at 4.5% and projected throughout this year by the Fed funds futures at the CME to maybe get down to around 3.5%. Japan, while it is the only central bank that's hiking, still only at 50 basis points. I do want to get to this piece, though, because it's a little bit more relevant these days.
Yeah.
The fear that's picking up in U.S. equities.
I'm so glad you brought this up because this goes back to, sorry to interrupt.
No, go for it.
We had it was an anomalous non-correlation.
Sure.
But it lasted for a long period of time.
Around here, like mid-2024.
Right. And the previous one lasted for almost a year.
Yeah.
Where we had a
back in 2022,
But this is one where, well, when's the correlation relevant? Is it relevant because it was correlated 20 years ago? I think this is a case where this long-term correlation starts coming back into play.
Yeah, and you're seeing it start to come back into play. This is some of the highest correlation we've seen really going back to the pandemic. And of course, 2012, 2013, until the pandemic, you're seeing a correlation between the yen and the VIX. So essentially
Right.
U.S. equity fear and the Japanese yen bouncing between 0.25 and 0.5. Now, we haven't really been north of 0.25 since the pandemic. Right now, right there, which has been the high, like I say, since the pandemic, as S&P 500 prices trade to the lowest since January of last year. We'll see if that fear continues. We'll see if the gap continues to close between Japanese and U.S. rates. But to your point, Pete, I think part of why this is so violent in this pair in particular, we're seeing U.S. dollar indiscriminate selling,
Yeah.
but this pair in particular is because, one, the prices are so extreme still. 140 is still the highest price if you take out everything from 2022 until now. That's still the highest price going back to the 1990s in this pair. And you've got that piece going, but you also have this fear that that gap that's closing is really going to close at some point. And the traders are going to unwind all of this carry trade that's been going on. It was the fear in the summer of last year when we got down to 140. Will we break 140 again? We will see. But for the time being, the U.S. dollar is continuing to crash. And this is probably the most fear around an unwind or a significant dollar crash back down to maybe the 130 handle, the 120 handle, what's been historically average for this pair in the last couple of years.
Absolutely. And this is if you're a momentum trader, this is setting up to give you, that kind of, the possibility of that kind of move. The markets are more elastic. We're getting into areas we haven't traded in a long period of time. If you're the contrarian, it's giving you extremes that are way outside the one standard deviation, even 30-day, let alone going back 6 months. But what it reinforces is there's nothing too rich or too cheap right now.
Sure.
Prices will go to levels that seem unreasonable. That's why we stick very tightly to our mechanics moving forward.
Absolutely.